Hey, what's up guys? It's ZQ Chiu here. So today I'm going to share a powerful trading concept that will change the way that you see the market: liquidity. So when you know where to find it and how to use it, you will be able to spot key opportunities that I would say most traders completely miss. So in this powerful video, I will uncover the 8 main liquidity zones on where you can find them in your charts, whether if you are trading, say, Forex, stocks, crypto, commodities, right? It works the same. Okay, so these 8 zones are so powerful that when you learn them, you will now totally understand, okay, firstly, like how the market actually works. But more importantly, you can now use these 8 zones to make money. All right, you're gonna like this. All right, so let's go. So first off, what is liquidity? So liquidity is the lifeblood of the market, right? The flow of money or large pending orders that drives the price movements. So every trade, like involves a what? It involves a buyer and a seller, right? And for every winner, there's going to be a loser, right? So in fact, when you lose a trade, you know what? You are actually contributing liquidity to the market itself. So understanding where this liquidity is and how it operates, right, is going to help you predict price movements, right? Build stronger strategies that is in line with liquidity. So without liquidity, price action would become, erratic, unpredictable, so making it harder to profit from, right, consistently. So to put it simply, liquidity keeps the markets moving, right? It creates the momentum that traders rely on. So liquidity is in essence, right, the foundation of all markets itself. So if you are a trader, you must understand liquidity. Okay? Liquidity represents zones on the market where a large pool of money, they kind of rests. That's how you can visualize liquidity, right? Such as, for example, what does it mean? Such as what? Stop loss levels, right? Or buy and sell orders. Okay? So these are the zones, right? So when a trader gets stop out from, say, a position, the market would absorb the funds that is tied to that stop loss, correct? So then it is what happens is that it is also often, say, speculated that the central bank or large institutions, they manipulate these liquidity zones, right? Creating scenarios that would mislead traders into thinking that they understand price action, right? So to survive, conspiracy theory, right? All right. So to survive as a profitable trader, it is crucial to identify liquidity zones on the charts, right? So these areas are key to understanding how the market moves and also, of course, preventing losses. Okay? Here we go. The 8 main liquidity zones in the market itself. All right, so these areas that I'm going to share with you where significant orders are present. All right, these are going to give you the insights into how the market dynamics is going to work. Okay, so liquidity can be identified in these areas of the charts itself. You ready? Number 1, equal lows and swing lows. So liquidity can often be found below previous equal lows or swing lows. All right, as these levels, what happens, right? They attract buying interest at these levels, and they result in what? In an accumulation of orders at that level itself. If you think about it, traders these days, whether it's in the past, whether it is this, whether it's going to be a future, traders are now so smart that they understand all these levels itself, isn't it? Right? So that's where a lot of, whether is it entry orders, pending orders, stop loss orders, are going to be at those levels. So those are the key crucial liquidity levels itself, which also makes sense why technical analysis works. Next, number 2, equal highs and swing highs. So this represents areas where liquidity are, right? So in these zones, what happens? There are what? Selling pressure, right? Selling pressure accumulates at that area, right? As traders, what? They place stop loss or pending sell orders above this area. Recognizing liquidity above equal highs or swing highs would help you to anticipate potential market movements. As price will likely seek out and they will absorb this liquidity before what happens? Before they either reverse or continue the trend itself. Number 3, dynamic trend lines and channel. So liquidity zones can be found right around these dynamic trend lines and channel boundaries, as what retail traders often place orders near these levels itself. Number 4, order blocks and order flows. So these are where substantial orders have been executed at those areas, or pending orders, they are concentrated at those areas itself, right? So therefore, this serves as liquidity zones. Number 5, support and resistance levels. I mean, support and resistance levels are one of the most commonly known base foundation of every trading. Therefore, with that understanding, liquidity zones are often at those areas itself, because this is where most of the public would draw with this understanding of support and resistance, especially big levels, big crucial areas, all-time highs, all-time lows, those type of crucial areas, right? Middle zone, etc. So therefore, creating strong liquidity zones as well. Number 6, daily candles body and shadow. So liquidity can also be found near the body or the shadow of daily candles, right? As these areas they indicate what? Price rejections and significant trading activity at those areas itself. Number 7, session highs and lows. So the highs and lows of trading sessions are often seen as liquidity zones, because what? A lot of people plot all-time highs, all-time lows of the daily levels, of these daily session levels itself. A lot of indicators automatically plot them as well, right? A lot of formulas behind the indicators are often plot behind all these daily highs and lows levels as well, right? So therefore, this creates what? A lot of trading activity and understanding of those zones itself, okay? And the last one, Fibonacci levels. So, I mean, likewise, traders, they frequently observe liquidity around those key Fibonacci retracement or extension levels. I mean, for example, the 50% level, the 61.8% level, or the 161.8% level, etc. Right? Because these are the levels that are widely followed by many. And if you notice, Fibonacci works, right? So there you go. Here are the 8 main zones on where liquidity is found. You found it helpful? Yeah? If it's yes, do remember to click on the subscribe button to subscribe to our channel itself. I mean, it really means a lot for me to keep creating quality videos like this itself. Cool? So now that you have learned the 8 liquidity zones, I mean, in theory, all right, I'm going to switch on to the charts itself. That's where you can see examples of how to apply the understanding of liquidity there. Take a look at this example. If we look at the left side of the chart itself, right, we can notice what? The break of structure to the upside. So that's where we can identify the order flows and the order blocks, right? That is evident, right? That the market did not respect the upper order flows and order blocks here. Yeah. So instead, what happened? The price dropped sharply. All right, they sweep the liquidity below these zones by triggering the stop losses of traders who entered the market at these levels itself. So now, after capturing enough liquidity, price used the upper zones as inducements level, reverse from the extreme order block, and then move sharply to the upside. Okay, so now what happened? Price has formed a what? A consolidation, right? An internal consolidation. That's where a small trend line is now emerging, right? Has emerged within this consolidation itself. To add on, there are equal lows at the bottom of the structure. So what? They create clear liquidity zone, both above and below, right? As these areas what are filled with pending buy orders or sell orders, and also like adjusted stop loss orders along the way. You know, traders adjust their stop loss order, right? When you recognize the importance of liquidity zones in price action, it's really essential, right? Why? The market often what? They gravitate, they move towards these areas itself. And therefore, if you ignore them or if you don't understand them, it's going to result you in losses that you do not know why. Okay, so the market gravitates towards liquidity zones. All right, key point, right? Never enter a trade without identifying a liquidity sweep pattern. So for instance, right, price reversal from the extreme order block, right? It occurs because liquidity has been swept below the upper order blocks and the recent consolidation zone. The market gains momentum by sweeping the liquidity. Then it creates this fuel, like this boost for the upwards movement itself. So, and that's how the market works, by understanding the liquidity zones. All right, so this example shows how price swept the liquidity below what? The equal lows with the large red candle, correct? So now, after reaching the order block, price reverse sharply, right? This makes the upwards move, right? To what? To sweep the buy side liquidity itself. Identifying and considering all these liquidity sweep patterns before entering the market, as you can see here, are a really important part of the whole process itself. So now, next, on the chart itself, we can spot this strong zone that has acted as both support and resistance. So above it, the zone has generated significant liquidity. So if we move our attention slightly lower, what happens? We can identify this bearish channel. Liquidity has accumulated where? Both above and below the channel itself, right? So as you can see, after reaching the order block that is formed by the change of character wave, price moves sharply to the upside, sweeping the liquidity above the channel and then triggering the stop losses of traders who had entered sell positions at that area. Okay, so now after which, price continued to move upwards, sweeping the liquidity above this zone itself. After showing a tiny retracement, price pushed further to the upside, sweeping the liquidity above the swing high zone. Okay, so now you get the concept. So I'm going to show you how to effectively use liquidity zones to set up trades in the market. All right, so now before analyzing all these price charts and examples, right, obviously it's important to understand the theory behind liquidity, right? So this foundational knowledge, right, will help us to what? Grasp how important all this price movement occurs in the market itself. Okay, so now let's imagine a structure, right, that simulates a typical price movement in the market. And that's where we're going to analyze further to explain how liquidity plays a key role. Okay, take a look at this. The price is in what? In an uptrend, breaking structures to the upside. So to set up a trade, it is crucial to first identify the underlying trend, which in this case is what? Is the uptrend, right? The bullish trend, right? So after placing the trend, the next step is to look for what? A valid break of structure to the upside, right? Because the trend is up, right? So you're looking for a break of structure to the upside. So therefore confirming the trend continuation, right? Therefore providing a what? A potential trade opportunity. So once a new swing high is formed, we can what? We can expect price to pull back towards this what? Specific point of interest, this level again, to feel the inefficiency that is kind of left behind. Before entering a trade, it is essential to identify a liquidity sweep pattern that occurs before price reaches the point of interest, right? Our point of interest, right? So this pattern signals what? The absorption of liquidity, right? This confirms the strength of demand in the area itself. As we talk about liquidity sweeps, they are a confluence factor before entering a position. So the key theory is that the market what? Needs liquidity to maintain the movement. Makes sense, right? The market needs liquidity to maintain the movement. So if price fails to sweep liquidity before reaching our point of interest, right? What happened? It will likely use that zone as a liquidity to fuel its momentum, making it kind of an unsafe area for trading because there's not enough liquidity. Okay, so in that scenario, we what? We observe a consolidation, right? Now we're gathering, right? Or an accumulation phase with equal lows itself. All right, so we want to see, right, the price sweep the internal liquidity that is accumulated below these equal lows, right? This liquidity zone is formed by what? Stop losses of traders who entered long positions thinking that the price pullback has ended. So since price didn't create new lower lows and lost the downside momentum, these traders, they initiated what? Now long positions, right? So once we get confirmation from the liquidity sweep, the next step is watching the price enter the higher time frame demand zone. Okay, so now as price moves towards this higher time frame point of interest, right? POI, point of interest, what we do? We focus on the lower time frame. All right, so within this zone, we look for character change, right? Change of character in the lower time frame, right? And identify new point of interest for our trade setup. Once these conditions, they're all met, that's where we're gonna go long with our target set at where? The external liquidity area, which is the swing high. So as shown, price reaches our point of interest, kind of mitigates it, and start moving forward to the liquidity, to the target liquidity zone, providing what? A potential entry point for the trade. As you see, price reverse to the upside after reaching our point of interest and mitigating it. So therefore what? It leaves significant amount of inefficiency in the market itself. So future price movement can fuel this inefficiency. All the future price movement can now fuel this inefficiency that gives us further trading opportunities at this area. Okay, so price also creates an internal high that is accompanied by small pullbacks and sharp upwards movement, right, resulting in a structural break. So this further confirms the bullish momentum and the continuation of the uptrend. Okay, so now as a result, we can now observe another structure break to the upside, what, creating a what? A demand zone linked to this break, right? And potentially reversing the price. It is important to note that another unmitigated zone near the break of structure, I mean, it can confuse traders on which zone to trade, right? So as we discussed, inducement areas are crafted by all these big financial institutions and smart money traders, right? Such as the central banks, right? So to mislead retail traders into taking the buy or sell positions, right? Therefore, what? Ultimately increasing the market liquidity. So therefore, when you are aware of these areas and the potential impact, it becomes crucial for making all these informed. Now you got like informed trading decisions. Okay, so the order block act as a trap, right? Creating false structure to trick traders into expecting what? A downward reversal, right? So what happens as a result? Traders are often induced to open sell positions, sell orders, placing their stop loss above the internal high. But however, price quickly moves towards the upside instead of continuing downtrend, breaking the recent structure. Okay, so this movement led to the formation of a fake demand zone and an order block, which caught the traders off guard and therefore sweeping their liquidity. Right, so in the subsequent movement, price moved downwards and reached the inducement zone. A small pullback occurs. A small pullback to the upside occurs. Driven by what? The buying pressure from traders who entered long positions at this zone. Alright, so this minor pullback further induces more price action traders to enter the market with long positions, right? Placing their stop loss below the inducement zone and setting up a potential liquidity sweep. So this collective activity forms a well-defined liquidity zone just below the inducement zone, giving area, right, for the market to sweep it. So traders who place their stop loss within this liquidity zone provide this potential fuel, this boost for the market momentum. So as we expect, the price successfully swept the liquidity behind the inducement zone, right? It confirms this anticipated confluence and validating the trading setup. So our next step is closely monitoring the price entering the higher time frame demand zone. So once price action is drawn into the higher time frame point of interest, we focus on the lower time frame. Within the higher time frame point of interest, right, we look for a change of character in the lower time frame, signaling a potential reversal. All right, so to add on, that's where you identify a new point of interest, a demand zone on the lower time frame where we can plan our trade entries. When these conditions align, that's where you can consider a long opportunity with our targets set at the external liquidity that serves as our take profit level. So now, I hope you have a solid understanding of how liquidity zones can now be integrated into our trading strategy to enhance the profitability, right? That's kind of how it works in the theory itself. Okay, for some of you it may be a lot, for some of you, oh, I get it, that kind of thing, right? For me, it took a while to get it, right? So don't be like, oh, this is so tough. No. It takes a while to let it sink to you. You can rewatch that part again. So now let's explore the real chart examples to see how this concept now applies in the real market conditions itself. Let's go. This chart, it shows the following price action. Price is in a what? It's in a downtrend, creating a series of break of structure to the downside. So after mitigating the previous order block, price sharply declined. So leading to what? To a break of structure confirmed by two large red candles. So therefore, further reinforcing the downwards momentum itself. Yeah. So now, this sharp decline left behind a significant inefficiency in price action. So we can now highlight the order block created here. So based on our analysis, we expect price to retrace and reach this point to fill the inefficiency left by the previous movement. Once the inefficiency is filled, price can now reverse from this zone and potentially resume the downwards movement. We can see that price retraced back up and form equal highs below our identified point of interest. So to add on, a notable liquidity pool has formed above these equal highs, indicating significant accumulation of pending orders and stop losses that the market may target for execution. So this presence of liquidity pool below our identified supply zones, they increase the likelihood of a potential price reversal from the supply zone. So traders who have placed their buy orders in this liquidity pool, they provide the fuel source, the boost for the market's downwards momentum. So as discussed, liquidity sweeps as a critical confluence factor in our trading strategy. So at this stage, we will wait patiently for the price to sweep the liquidity above the equal highs and enter our identified order block. Now you can see that the price has successfully swept the liquidity above the equal highs and now has reached our point of interest. So this gives us the desired confluence that we are looking for in our analysis. So based on this confluence and our market assessment, we can now consider entering a position. Okay, so now next, we will zoom in to the lower time frame now to get a clearer view of the price action, right? And look for any signs of change in character, which will further confirm our trade entry. You see, it start to all piece together, right? So now here, we have the lower time frame chart, right? As you can see, price created a major change of character by breaking this structure to the downside, and also left an incredible inefficiency behind. So in the next step, that's where we highlight the order block created by the change of character with, right? So here we can spot the VSR, the valuable support resistance pattern, which indicates a strong rejection from the higher time frame supply zone. So this suggests that using this zone for a short position is highly likely, right? Providing another confirmation for our entry. All right, so now we have identified our point of interest. We can proceed with our trade setup based on these confirmations itself. The next step is to place a sell limit order at that level. All right, so then to manage your risk, we will adjust our stop loss a few pips above the highest point of the zone. Our target for this trade is the 15-minute swing low, right? As we anticipate the price will move in that direction. So we are officially in the market once our sell limit order is triggered. At this stage, that's where you gotta closely monitor the price action and observe how the trade develops. So as you see, price begin to move downwards after activating our sell limit order. Eventually hitting our take profit target, giving us a nice risk to reward ratio of 1:15, which is a fantastic trade. But it is important to remember that each trade outcome obviously can vary, right? So therefore, you got to apply risk management and you got to have strict adherence to your trading plans to be aligned with your overall trading system. Okay, so I know that's a lot for you to absorb. This started off as an easy video, but then we start to go into all these theories. Like I said, some of you who are new, this is a lot. Some of you who has already understand the concepts, this is understandable and oh, I get it. Yeah. So those who are new, just watch this again, right? Bookmark this, watch this again, right? You're gonna see how you can add this to your current trading strategies. Good. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.